How to trade volatility. Now, a lot of people have a misunderstanding that volatility is a good hedge for a portfolio. It's not. It's not a hedge. It's more of a trading tool. It has seasonality, which we'll talk about in a minute, and it's not something you want to rely on in a long position because typically it goes downward. Here's probably the most popular ETN, exchange traded note, for volatility, VXX. You buy it just like you would a stock, put in this ticker to buy it. But look at the long term. Look at what happens in the long term. We went all the way from 7,000 down to where it is now at around 13, 16 now. If you had gone long on this, like many people did, you would have been out a lot of money. What happens with this? What happens with the VXX, the VIX, and the TVIX, which is the other instrument, is you are dealing with an ETN, and it's a leveraged ETN in the case of the TVIX. Think of them as the same. They are both mimicking volatility, which is a measure of, you could say, variance in the market, how the market moves, how quickly it moves. You should probably look up volatility real quickly and come back once you've understood it. But to clear up a couple misconceptions, first of all, it is not a measurement of fear in the market. And second, volatility can rise when the stock market also rises. So don't misunderstand what volatility is. It's just a measure of how things change. Yes, high volatility is correlated to stock prices going downward, but it's not always the case. Now, unlike stocks where you have a limited number out there, and if you buy, I have to sell, and if you sell, I have to buy, things like the TVIX or the VIX, these exchange traded notes, as many people who want to get into them can get into them. Check out the volume here. The volume has steadily risen since I believe the summer of 2015, when it looked like there was going to be a market crash. Lots of people started to buy this as a hedge. That's why this has become popular. People think it's a hedge. Like I said, it's not a hedge. Okay, so let's take a step back here and look at the VIX because it's been around longer and the drop is more extreme. Now, it keeps going down. It's like a fractal. The max, when you click on max, it shows you all the way back to the beginning. 10 years, same thing. 5 years, same thing. It's like a fractal. It continually goes down. The only time we've seen it spike recently have been during those market corrections. So people are thinking, well, if I hold on to the VIX, what will happen is when that market correction comes, it spikes and I make money. Well, if you're holding on to it, you're not making money. You've got to sell on the spike. You have to treat the VIX like a penny stock, and in a minute I'll show you how you're going to be able to do that. You have to treat it like a penny stock and sell on the pump. Sell before the dump. You cannot hold on to this. The VIX is almost always a safe short because of that fractal-like nature. It's always going down. The way the ETNs are created on volatility is that they are futures, and every month they have to be rolled forward, and that makes it lose value. When they're rolled forward, they inherently lose value. Even if volatility is trending sideways, your exchange traded note on volatility is going to drop. That's the problem with these. That's why it's always a safe short. But well, safe is quite relative. It's not always a safe short because these spikes like these yearly spikes, you see, these could get you a margin call if you're short on the VIX. So it's not really a safe short, but it's pretty much always safe to buy puts on or any other options strategy that goes downward. You might want to deal with theta by theta hedging. You could use something like you can use a credit spread. But the idea here is that if you want to play the VIX, generally, if you want to have a long-term position on the VIX, generally you want to be bearish on the VIX. What people are doing these days, as you can tell by the volume, spike in volume, what people are doing these days is they're using it as a hedge. They're keeping it in their portfolios. They're seeing it lose value every day, and they're kicking themselves. They're thinking, why am I holding on to this if it just keeps going downward? And then they're reminded of these spikes and they're hoping one will happen. Well, that's not the best way to play this, and I'll show you how to play this in a second. Let's first take a look at, well, let's step back for a second. VIX and TVIX, you can play either one. Their seasonal profile are pretty much the same. How they act is pretty much the same. It's just that TVIX is double leveraged, so it's more volatile. So you're going to see bigger spikes in the TVIX than you are in the VIX. And the TVIX is cheaper. Alright, so there you go. They basically look the same. For liquidity purposes, the VIX is better. And for our purposes of playing options on this, which I'll show you in a second, we're going to go with VIX. Why? Because TVIX you cannot buy options on. So we're going to talk about VIX in terms of making trades, but we're going to talk about TVIX for seasonality because TVIX has been around longer. Alright, so here's the first thing I want to show you guys. These are two charts, two line graphs of what happens if you hold on to the SPY. One of them, the black one, is if you just hold on to the SPY. Buy and hold, never let go. After, well, it's been 14 years, you would have made 300% of what you invested. Now, the main problem with this is that you're 100% exposed in the case of a market crash, like we had in 2008. What you're seeing in the red line here is a seasonal strategy on the SPY. It's the same thing, except it's adhering to that buy in May or sell in May and go away paradigm. So the idea here is you are buying the SPY in November, you're holding until May, and then you're selling in May. And what that gets you is this graph here, 400% return on investment. You've almost completely avoided that market crash. So we've got a superior strategy here in the seasonal SPY strategy. Now I have played around with another strategy where we're not directly investing in the SPY, instead we're investing in, I'll show you what it is. I closed it. Instead we are investing in different sectors of the SPY. We have different ETFs. If you're not sure what the SPY is, just remember it's essentially mimicking the S&P 500. It's an ETF that mimics S&P 500. You just type in SPY, you buy it like a normal stock, ticker SPY. That's what you got. But you also have other things like XLK, which is mimicking the technology sector of the SPY. And you have XLE, which mimics the energy sector of the SPY. Now I found a better strategy, and that strategy is as follows. Instead of playing with a SPY, what you do is you, in September, instead of November, in September, you buy XLK, the technology sector, and then in February, you drop that for XLE, and then in May, you sell and go away, you buy bonds. So you might want to buy TLT, which is an ETF that mimics bonds. Now, you might be looking at this August thing, and that's what I'm going to tell you about. So, if we take a look at what happens to the TVIX each month, we'll see that August is very strong for the TVIX. It's almost always up. Percent positive is 60%. The average gain is way above 40. It's around 50. And you got a huge Sharpe ratio for August and August only. Well, you got September, but it's not important. And I'll show you why. The TVIX and the VIX, you could do the same seasonal strategy analysis, and you'll find that they're both really strong. Here's the VIX. They're both really strong in August. VIX is somewhat strong in May. TVIX is not. TVIX is somewhat strong in September. But they've got this overlapping quality. They're both very strong in August. So that gave me an idea. What would happen if we add, not a hedge, but if we add the TVIX to our portfolio in August? Well, clearly this should help us instead of bonds, so we should benefit from this. And here is the strategy going back to 2011, since that's as far as TVIX goes back. And we can see we are not as good as the sell in May and go away strategy, but we could be. We could be. We're still better than the SPY, but we could be better because look at these big spikes. Here's what these are 100% due to the TVIX. This is a gain in the TVIX. This is a drop in the TVIX. Drop in the TVIX. Gain in the TVIX. Gain and then a drop in the TVIX. If we trade the TVIX intelligently, and I'm talking about trading, not hedging, not investing. If we watch the TVIX, if we buy it in August and we watch it closely, and we set take profits and stop losses, then we can actually beat the SPY and the seasonal strategy, because we'll have gains like this added to our portfolio. If we did this in 2001, we'd already be at 2.5, 250%. That's 150% ROI. That's half. That's more than half of the seasonal strategy. So you can play the TVIX in your portfolio, but you have to play it. You have to use it as not a hedge, but as a swing trade for that month. Now, we want to avoid these drops down and we want to capture these spikes in price. So we could do that through stop losses and take profits, but you can never 100% guarantee that the stop loss is going to work or the take profit is going to work. A better method for this is one that limits the downside while not limiting the upside. And it's an option strategy called the ratio back spread. Here's an example of it on the VIX. Now we want to use the VIX because we can't trade options on the TVIX. Now it's May, and obviously we want to trade this in August. So you'd want to move May to August and June to September, and you'd have this type of strategy. The idea is VIX right now is trading at about 17, and we are going to sell one. Here it says May, but we're going to say August 17 call, and then we're going to buy two of the calls that maybe are $4 or $5 above in strike price of the previous one, and 1 month out. And what happens is, depending on your strike prices, you could open this at a credit, but we're opening this at a debit. But check this out. The max risk is whatever we spent on this, but the max profit here is unlimited. So we gain all that upside, but really none of that downside. So these downward, these huge drops in price, you won't see in your portfolio if you, in August, play the VIX like this. Now, understanding the ratio back spread is not that important. It's a play both on direction and on volatility. So it's a bit confusing because now we're talking about volatility of a ETN that tracks volatility. That's a second derivative of volatility, making it a little confusing. But just know that because Vega is positive, every time the VIX increases in implied volatility by 1%, this whole strategy increases in $2.8 by $2.8. And because we have this high open interest and these low spreads, these tight spreads, this is a very decent strategy for pretty much anyone, even if you're new to options. Safe. It does require a bit of margin, but better to have that money in margin than in the VIX or the TVIX that could drop very quickly. So that's it. Hopefully you understand now that if you want to do a seasonal portfolio, the VIX is not a hedge. Instead, it's an August trade that should be a trade that allows you to limit the downside while gaining all that upside. And the only way you can really do that is with options. So I hope this has helped you in planning your August trades and helping you learn how to trade volatility. And if it has, please like this video, subscribe for more videos of this type, and if you want to request a video or topic or anything like that, please leave your request in the comments section below. Thank you.